All right, this is going to be a really quick um, video. Not even going to look at a chart to see which way prices are going to go. I just want to ask this question because there's been a lot of people, bears in particular, who have been saying these rallies have been on weak volume. But I want to ask you to consider something as a possible explanation for why the rallies have been on weak volume while the consolidations have been on heavy volume. Let's talk about it. Okay, we're looking at a 4-hour chart of the S&P 500, and this is what I want to ask you. This leg from here to here happened on relatively weak volume. Then we had heavy volume all throughout this area, and now people are saying, well, we're getting weak volume again. Traditionally, that would be a strong warning sign, because traditionally areas of consolidation would dry up on volume, whereas areas of rallies would increase in volume to prove and to show the validity of the move. But these principles were established long ago. They were principles that were observed in the early 1900s, the middle 1900s, and it wasn't until pretty recently that we started seeing more of these low volume rallies. And I want to ask you just to consider one thing. With the amount of high frequency trading that we know the markets are subjected to, does it not make sense that in an area of a relatively straight line move, for there to be less opportunity for these algorithms to kick in and trade out multiple times in an hour, whereas the move is going pretty much straight up? Now we get into this really choppy stuff, and all of a sudden the machines can go wild. They can pick up all kinds of turns and twists, and all of those little what am I trying to say? All of that volatility that is associated with consolidations. The machines take advantage of that. The computer algorithms kick in, and they trade the ever-loving daylights out of all of this sideways action. Then when the markets finally straighten out and start to go up, there are simply not as many opportunities for the high-frequency traders to do their thing. I want you to consider that, because obviously something is going on, and it's something a little different about these markets than what we've been used to in the past. I offer that as a potential explanation. For me, it makes pretty good sense. But because obviously if you had an algorithm that could trade all of these turns in here, you're going to create very heavy volume in this chop. But when it finally starts to straighten out and go up, there's simply not as many opportunities for algorithmic trading to take place, and the volume is going to suffer as a result. This is a little editorial comment brought to you by freechartvideos.com. Log on to the website. See the charts. They're free. And I think you'll learn something. I do not use new methods. I use time-honored techniques to understand modern markets. I use methods that some people have forgotten about, but they have been saying we are in a bull market since April 15th of 2009. And I think if you look back on your charts and look back to April 15th, 2009, I think you could see where that call was the right call. We still have a lot of bears hanging around. That's good. As long as there are bears, the market can continue to go up. But I'll be honest with you, they're wrong in their analysis. They're teaching sentiment and fundamentals over sound chart reading techniques. Guys, when you get these kinds of chart patterns that we've been getting over the past year and a half, they speak of very strong bullish markets. You have to ignore the news programs. You have to ignore what you read on the internet. You have to read the chart and trust the chart, because the chart is getting it right. So anyway, sorry, I'll get off my soapbox. Just wanted to share this volume idea with you. And good trading. I hope you come to a favorable resolution with your market sentiment in light of reality. Take care.